Hello and welcome to this special show on how to select fixed income funds by DSP Mutual Fund. When it comes to finding a solution for our short-term investment requirements, we choose fixed income funds or debt funds as they are popularly known as. These funds are considered to be less volatile, less risky as compared to their equity counterparts. But do fixed income funds have no risk at all? Given that there are so many different types of fixed income funds, do we even know which ones to choose and for what duration? So to help us demystify fixed income funds today, I have with me Mr. Aniruddha Bose, Chief Business Officer, FinEdge Advisory, a leading tech-enabled financial planning platform. Aniruddha isn't a new face to many of you, but for those who don't know him yet, he holds an MBA with distinction from Oxford University and has close to 2 decades of experience in the financial services industry across wealth management, private banking, and financial planning. Outside of work, Aniruddha is passionate about running and is an avid marathoner. So welcome to the show again, Anirudh.
Thank you so much, Sumana, for having us here.
Thanks to you as well. Your insights on equity funds in our last conversation was so helpful. So guys, if you want to check out that video on equity funds, the link is provided below. Before we start our conversation on fixed income funds or debt funds, request all viewers to put their questions in the comment section and we shall get back to you at the earliest. So let's start by understanding the basics first. Aniruddha, we all understand investing in fixed income funds or debt funds help us meet our short-term goal requirements. But from your perspective, what matrices should investors use to evaluate debt funds? In fact, if you can help us understand some common terms like average maturity, yield to maturity, and portfolio durations on a mutual fund scheme. Also, if you can explain the relationship between interest rates and bond prices of debt fund yields.
Sure thing. I'll give it my best shot because like you rightly said, debt funds are actually a lot more confusing than equity funds. More people understand how equity markets and equity funds work than debt funds. And so here goes. Let me just start with a few commonly used terminologies and I'll, like you said, try and demystify them. So the first one being average maturity, which is, I think, the easiest one to understand. So average maturity is essentially nothing but the weighted average of all the residual maturities of the paper that I'm holding in my portfolio. So if I'm holding 10 different bonds or papers or commercial papers or CDs, the weighted average of their remaining maturities is the average maturity of my overall portfolio. YTM, slightly more complicated. So YTM is basically nothing more than the actual CAGR, the return I will earn if I buy a certain bond and I hold it to maturity. Okay, I'll give you an example of how that works. For example, a lot of people actually don't understand that bonds also fluctuate in price, right? I may have a bond with a face value of 100 rupees, but it could be trading at 95. So just to give you a very simplistic example to explain how YTM works, if I buy a bond that had a face value of 100 rupees from the market at say 98 rupees, and let's say that bond had a coupon of 7%. So, and it's going to mature in a year. Very simple example. So I've bought it at 98, right? In a year, I will receive the face value plus the 7% interest, right? So I'll actually invest 98 rupees and I'll get back 100 rupees plus 7. So I'll get 107 rupees. So that's how it works. So I actually get 9 rupees on an investment of 98. So that YTM works out to 9 divided by 98 in percentage terms. So the YTM actually takes into account the current bond price.
Right. And what about the relationship between interest rates and bond prices, Anirudh?
Okay, you did tell me that I should explain it as if I'm explaining to a 10-year-old. I was up all night wondering how I'm going to do that because it's not so simple. But anyway, here goes. So let's say I have a bond which has a 7% coupon. Coupon means the annual interest that the bond pays. It's the simplest thing to understand about a bond, right? And for some reason, interest rates go up. For whatever reason, the RBI could be trying to control inflation or whatever. and the interest rates go up. And now the same type of bond, by same type, I mean the exact same risk profile of the bond, right? Let's say AAA bond is now available at 8% because overall broadly market interest rates have gone up. So let me ask you now, if I go and tell you that buy my bond for 100 rupees, would you buy my bond for 100 rupees considering it's giving a 7% coupon, or would you go and just subscribe to that new bond for 8%?
Obviously, I would look for a higher interest rate as
Exactly.
an amateur investor.
Absolutely. So to compensate you for that loss of interest rate, if you buy my bond, I would have to price my bond a little lower. That's when it becomes sensible for you to go and buy it. Otherwise, why would you, right? You did the math. So
Absolutely.
I would go and say, okay, I will sell my bond for 99 rupees. Let's arrive at a deal. I'll sell it for 99. And then you'd say, okay, that kind of makes sense, right? Because you would make the same or a little more by buying my bond. But what's happened in the process is my bond price has fallen. The bond I bought for 100 is now trading for 99. So that's an example of how a rise in interest rates has resulted in a decrease in the bond price that I'm holding, the price of the bond that I'm holding. Similarly, the reverse also applies. So if interest rates fall, my 7% bond suddenly becomes dearer because the same kind of bonds are now paying 5%. So why would I sell it to you for 100? I would say, no way, I'm going to sell it to you for 102. You want my high coupon bond? Pay me.
Absolutely.
Right?
It makes
so then
sense.
bond prices go up.
Right.
So that's the inverse correlation between underlying interest rates in the market and bond prices, broadly speaking.
Very well explained, Anirudh, I should say. My next question is on the underlying components of debt funds. So we understand they are made up of CDs, CPs. We keep on hearing these jargons, NCTs, government securities, or money market instruments. Would you help us with some one-line definitions of these underlying instruments of debt funds?
Sure, why not? So when I talk to people, I say, okay, there are two basic kinds of borrowers. One is the government, right? And one is companies and even financial institutions or banks. So broadly speaking, the kind of security that is issued within fixed income portfolios depends on who's issuing it. For example, when you talk about a treasury bill, that's a very short-term borrowing by the government, ranging from, I believe, 90 or 91 days to 365 days. So it's a short-term borrowing, and it doesn't even have a coupon. It is issued at a discount to maturity. And it, at the point of maturity, it matures at the face value. So that's one type of underlying security. Then you've got the longer duration government securities that could be anything from 10 to 40 years in duration. That's the government's long-term line of credit from the Janta, right? Those will obviously carry a higher coupon usually because you're asking for my money for a much longer period of time, right? So these are your GSECs, as they call it, the government securities. In principle, they don't have a default risk unless, of course, you are a country that's going to go down. Okay, typically that doesn't happen if a country is financially fairly sound, like India is. So those are your government securities. Then you've got various kinds of time deposits. Like, for example, when you talk about CDs, those are actually certificates of deposits. Those are basically just like your banks or savings account. They're basically time-bound deposits issued by banks or financial institutions. The corporate equivalent of a CD is a CP. That's a commercial paper. Right. So for just the way when a bank has to borrow it for the short term, it issues a CD. When a company has to borrow for the short term, it issues a commercial paper. These are, of course, less secured. They're an unprotected kind of form of debt. So CPs typically don't have any underlying asset that is securing that particular loan. There's no collateral. I believe CPs are again a short maturity kind of a portfolio. A short maturity paper ranging from about 7-8 days to about a year. So these are your CDs, CPs. Then you've, of course, got bonds and NCDs. Many people are confused between bonds and NCDs. So they are similar in the sense that both are typically used for longer term borrowings. And bonds are actually issued by much larger institutions. Okay, for example, large corporates or the government. Like I said, the GSEC paper is basically a type of a bond. And then you've got NCDs, which are non-convertible debentures, which are also a type of fixed income security, which basically is usually unsecured, shorter term, while a bond may be a longer term duration ranging from 5 to anything from 40 years. An NCD will typically be a shorter term, often unsecured, slightly higher risk kind of a borrowing compared to that. So that's your mix of all the fixed income instruments that are there in a typical bond funds portfolio. Even deeper, you've got SDLs, which are state development loans, which are also a type of government security, but issued at the state level. Those also carry a certain amount of sovereign risk, but essentially they are fairly secure. So these are the various kinds of instruments that debt funds typically hold.
So at FinEdge, Anirudh, how do you select different debt funds for your clients? Typically, what process do you in fact follow before suggesting these funds to your clients? And do you think risk profiling is relevant for for these set of clients? Do you do risk profiling before suggesting debt funds to your clients?
So at FinEdge, we've got a slightly different take on the overall utilization of debt funds as a whole. So we've got a simple view that basically return of capital is more important than return on capital. Okay, so we really don't like to take any kind of incremental risk on a debt portfolio. I'll tell you why. We only suggest debt funds either for very short-term goals, basically either 1, 2, or 3-year goals. I'm sorry. Or for the temporary parking of money. For example, if I want to invest in an equity fund, but I'm a little concerned about where markets are in terms of valuations, I may want to invest that money in a liquid fund or a short-term debt fund and start an STP or a systematic transfer plan. So in effect, we either use it for very short-term goals or as a temporary parking space. Since we do that, we really don't believe there's much sense in taking incremental risk just for the sake of achieving a 1 or 2% extra return, because I'll tell you why. A 1 or 2% extra return does make sense when it comes to very long-term goals, right? When you're talking about 10, 15, 20, 30, 40-year goals, even a 2% return can make a dramatic difference to your overall end corpus. But over a 1 or 3-year period, a 2% return just doesn't make much sense. It's not worth taking the incremental risk that the fund manager would have to take to achieve that incremental 2%. So we believe there's to be a very strong case for any client to move outside of FDs. And there are many times that we tell clients, no, it doesn't make sense. It's not very clear right now. We don't understand where the credit situation is, where interest rates are headed. So just keep your money in an FD, irrespective of the tax inefficiency of an FD. So that's our stance on debt funds. We really don't see them as something which you need to apply too much of your mind to in terms of really trying to evaluate how to get that alpha or that extra 1, 2%. We'd rather, you put your money in a debt fund and sleep well at night and earn a couple of percentage points less, then aim for that extra couple of percent through a higher credit risk or by taking a very high interest rate risk and end up maybe losing your capital. Again, because the perception of many people is debt funds is an alternative to FDs. And however much you may try and educate them on the various risks that are there, which I think we'll talk about later, fact is people do get into debt funds as an FD plus kind of a instrument. So if they end up losing money there, even in the short term, it does cause them a lot of pain. Right. So to answer the next part, risk profiling, we don't really assign risk profiles to people. As a company, we assign risk profiles to goals. And we don't believe that it's fair to label someone as high risk, moderate risk, low risk, and assign investments accordingly, simply because you may have various buckets of money that you want to create for specific goals. For example, if I may want to buy a car in a year, yeah, sure, a liquid fund may make a lot of sense. But if just because I'm low risk, I'm a low risk taker, doesn't mean I should keep that liquid fund money for the next 10 years for my kids' education, right? So I need to educate myself on the various risks involved. So just the same way that we do risk profiling for specific goals when it comes to equity, we would assign a debt fund of any kind to a very short-term goal or a temporary parking.
Understood. I will be coming to the discussion on risks, but I'm curious about the taxation aspect that you just mentioned. We often hear experts saying that debt funds are more tax efficient than the traditional fixed deposits. And here you say that, you tell your clients to use fixed deposits as and where it is, you think it's more suitable. So if you can help us to understand that tax efficiency of debt funds a little better, and you can also tell us about how indexation can actually be used to take more benefits out of taxation of debt funds, Anirudh?
Sure, valid question. I'll try and explain where our dilemma arises. The tax efficiency of debt funds come through only after 3 years, right? And when it comes to a 3-year plus kind of an investment, it is true that there are often better investment options available. Maybe an equity savings fund, maybe a debt-oriented hybrid, maybe even a dynamic asset allocation fund for a 3.5 year period. So to stay put in a debt fund for 3 years just to achieve that tax efficiency begs the question, are there better options available within that stipulated time frame? So which is why we don't typically position debt funds for their tax efficiency, because then you may be doing a disservice to the client in terms of a better option being available that you're not talking about, which may be outside the realm of debt investments. However, there are many a time that clients will want to park 3 or 4 year money in a debt fund. That typically happens with a wealth management client who's already accumulated a corpus and is looking to create an asset allocation, which is an altogether different strategy from a client who's looking to accumulate a corpus, right? So for such a client, yes, a 3, 4 year, even 5 year investment in a debt fund might make sense. Here's how it works. A lot of people complicate it a lot. When I have to really simplify it, what I say is any debt fund investment made for more than 3 years ensures that only your returns earned over and above inflation are taxed. Okay, so when people talk of indexation and cost inflation index, etc., it can get a little confusing, but if you understand it conceptually, these 3 years that I've remained invested in the debt fund, there has been some sort of inflation, right, at play. Absolutely. So what indexation means is I will only have to pay tax on the returns earned, if any, over and above inflation. So for example, if the value of 100 rupees has eroded by 10% in 3 years, and my debt funds have given a return of 15%, then I'll only need to pay a tax on that 5%. That's the simplest way to understand it. Now, the underlying calculation is based on CII, etc., financial year of purchase and sale, but that's conceptually how it works. And I'll have to pay 20% on this 5 rupees. So, of course, it does work out to tremendously more tax efficient returns than, let's say, an FD, where regardless of whether I did a 1 year FD or a 3 year FD, I would have to pay my marginal tax rate. Now, if I'm at a zero tax bracket, of course, that will be tax free for my FD as well. That's a unique scenario we came across actually sometime back, where debt fund returns after 3 years were less tax efficient than an FD for a client whose overall returns did not cross the tax bracket because they were non-earning. It was a homemaker. And an FD return actually would have been tax free because it would be counted as capital gain, taxed into the income, and there was no income, barring the FD income. But for an FD, for a debt fund, you would have to pay capital gains tax regardless of your tax bracket. So that is one unique scenario where your capital gains tax actually may exceed your indexed capital gains tax may exceed your short-term capital gain tax. But in general, for most of us, if you hold a debt fund for more than 3 years, since you'll only be paying 20% on the inflation-adjusted profit, they do end up being a lot more tax efficient.
Thanks for sharing such a different perspective about the taxation of debt funds, Anirudh. Would you tell us about the risks associated with debt funds? So what are the key risks involved when we invest in debt funds? And if you recollect in the past, there has been instances where there has been defaults with regards to debt funds. So are there any specific funds that investors need to avoid when they're investing or choosing fixed income funds or debt funds?
A very valid question. Most of us, unfortunately, still believe all debt funds are risk-free. It's certainly not. And we've had a lot of events in the past 5-7 years which have proven just how dangerous these risks can be, because unlike equity risks, which are visible and more predictable, okay, I'm seeing CNBC and I'm seeing my stock tank, at least I know that it's tanking, versus waking up tomorrow and getting to know that my portfolios had to take a haircut of 50% overnight because the bond I was investing into defaulted. The two risks are very different, right? One is more visible, more predictable, and one is extremely shocking. Now, coming to the different kinds of risks, primarily there are two. Of course, there are others also which are less relevant, but the two main kinds of risks in debt funds are credit risk, which is also known as default risk, and your interest rate risk. To explain credit risk, I like to tell people that Institutions are just like people. So if I'm lending money to a person who's unscrupulous and not very credit worthy, there's a chance I won't get it back, or he's going to, delay my repayments, right? So that same risk is also there with when I'm lending to companies, especially companies that are, let's say, very over leveraged, where a single event can trigger a very bad cascading cycle of having to refinance their debt and then cause a default, right? So there are, of course, indicators, and there are basically credit rating agencies that evaluate the balance sheets and the capacity of companies to service their debt, and then assign a credit rating accordingly. But credit ratings are not the holy grail always. There have been defaults in highly rated companies also because of oversights and because things can unravel very quickly. So even AA rated companies have suddenly defaulted when the chances should have been very slim. But that's your first kind of risk in a debt fund, your credit risk. And basically, another subtle form of how credit risk plays in is if the company I'm investing into gets downgraded, right? I may be investing into a AAA rated bond, but suddenly that company goes through some kind of trouble and gets downgraded to a AA. That bond price will fall again, even at that point, because it's suddenly not that dear, right? That coupon of 7% is not good enough to compensate an investor for the additional risk, because now that's a more risky paper. That's another reason why bond prices could fall. So bond prices could fall due to a re-rating, or you could have something as bad as a haircut or disastrous situation like we saw in 2020, where appetite for low risk bonds completely fell to literally zero. So when redemption pressure came in from investors during the pandemic, you suddenly had a situation where the fund manager just couldn't liquidate their portfolio to honor those redemptions, right? Because the first thing that dries up from the liquidity perspective is the appetite for high risk paper in such a scenario. So the ways that credit risk plays out is sometimes very sudden and can be very shocking. So people should be very careful while investing into any fund that has a fairly high, and by fairly high, I mean anything more than 10, 11% allocation to lower risk paper would have to be viewed with a lot of caution. Again, coming back to our original point, why at FinEdge, we really don't believe that incremental 0.5%, 1% return is worth the risk of that entire 10% being reduced to zero. So that risk reward doesn't play off, especially for shorter term goals. So risk should be the extra 2% is only worth it when I'm investing for something very long term. That's just how compounding works. The other kind of risk is interest rate risk. I explained that to you earlier in the discussion. When interest rates go up, then the bond I'm holding essentially is less dear, is less valuable, because I'm holding a 7% while the market is offering a 9%. So my 7% bond will fall in value to reflect that that change in the scenario, and vice versa. So this is also a risk, and people don't understand that. A lot of people assume that gilt funds are risk-free. I keep telling them that they're not at all risk-free. The reason being that gilt funds essentially are the highest duration. So this is a term I'd left out earlier. I'll take the opportunity to introduce our viewers to it. There is something known as portfolio duration or modified duration, which is basically tells me how sensitive my debt fund portfolio is to changes in interest rate. So every debt fund is not equally sensitive to changes in interest rate. While a 1% repo rate hike may impact a liquid fund very less, it will impact a fund which has a 10-year maturity much more, right? Because ultimately, that change in cash flow, because of the difference in coupon rate is amplified with the number of years. So a 10-year bond will be a lot more impacted by a 1% change in underlying rates than, let's say, a half-year bond or a portfolio with like a liquid fund, which has literally a maturity ranging from 30 to 90 days. So that's where portfolio duration comes in. While all bonds are sensitive to interest rates, gilt funds, which have an average maturity of portfolio duration of anything from 5 years to 10, 11 years, are much more sensitive. That basically means a 7-year duration means that a 1% change in underlying interest rates or yields will have a negative 7% impact on my portfolio, and vice versa. Similarly, a 10-year modified duration means that a 1% change in underlying interest rates will possibly bring my capital losses to about 10%. So imagine that. So that's your interest rate risk. So when you're investing into a longer duration, longer maturity debt fund, it's very critical to understand how this interplay of duration or portfolio duration and interest rate changes actually plays out. Otherwise, you will be in for some rude shocks, and you'll go back to your advisor and say, hey, I invested in a government security fund. How is it down 7%? And you'll find it very difficult to explain why. Because most people assume that a gilt fund or a debt fund is an FD. They don't understand that the underlying portfolio is fluctuating in value constantly. There is a very vibrant debt market where bonds are being bought and sold in higher volumes than equity.
So irrespective of being less volatile than equity funds, debt funds do have a lot of risks. And I think it's very, very important for our investors to evaluate the options by discussing with their advisors. Anirudh, another type of risk that I often keep hearing about is reinvestment risk. What is reinvestment risk in the context of debt funds?
Reinvestment risk is more relevant to close-ended funds. So basically, there are two kinds of debt funds. There are close-ended funds and open-ended funds. So close-ended means I can't subscribe to it anytime. It's only during the NFO, and I can't also withdraw at any time, like a fixed maturity plan, for example. An FMP is a close-ended fund. So I'll give you an example of how reinvestment risk can play out. I've got a choice of investing in an FMP for 3 years or 5 years, let's say. Okay, and I say, okay, let me invest in this FMP for 3 years. And I'm targeting an annualized return of around, let's say, 8%, hypothetically. Okay. My friend decides to invest in the 5-year FMP and locks in a similar kind of a return, slightly lesser, maybe 7.5. Now I receive my money back at the end of 3 years, and I go back to reinvest it. And at that point, let's say interest rates have fallen to 5%. The way it happened during the pandemic, right? I mean, the RBI had to take drastic measures to bring down interest rates and infuse liquidity to keep the economy afloat. Now, if I roll over this investment into another FMP, I will only earn about 5% for the next 2 years. While my friend who locked in the money for 5 years will earn a constant 7.5% throughout. So by choosing a shorter maturity, close-ended debt fund, I am exposing myself to interest rate risk. And remember, the opposite also works. It could well have been the other way around, where my money matured and interest rates were much higher. So I was able to invest my money at a much higher rate than my friend who's locked into 7.5%. Risk always is a double-edged sword, right? I mean, it can increase your returns or reduce it. But that's how reinvestment risk works. It can work for or against you.
Right. When it comes to plans, what should investors choose? A growth plan or a IDCW or erstwhile dividend plan?
IDCW is, first of all, so complicated sounding. To date, I don't even know what it stands for. Income. I don't know. Anyway, so I know that it's what dividend used to be. So
exactly.
So certainly growth, I would say. So there's a massive DDT that is deducted in all IDCW options, right? And for debt, I believe equity is lower. For debt, I believe it's closer to 30%, 29 point something. So irrespective of my income tax bracket, I will have to pay 29% DDT, because that's going to be deducted at source and the money is then going to come into my account. So I don't think it makes sense to pay that. Besides, even from an investment objective perspective, usually people who go in for a IDCW kind of an option are looking for income, right? There can't be any other reason. I don't want my money to compound within my portfolio. I want to withdraw periodically in order to fund some requirement of mine. An SWP strategy works a lot better. An SWP stands for a systematic withdrawal plan. So I would say go for a growth option and start an SWP. What happens then is certain number of units get redeemed every month or quarter, and I'm only taxed on the profit on those units earned. So if, let's say, I've invested into 10,000 units and I redeem 500 units through an SWP every quarter, so I'll only have to pay capital gains tax on the profit that I've accrued on those 500 units. So it works out to a lot more predictable cash flow kind of a scenario than IDCW. And it also certainly brings down my tax liability.
Right. So before we move on to the next set of questions for Anirudh, to all the audience here, if you are enjoying our content, please like the video, subscribe to our channel, and press the bell icon to get the latest video updates from DSP Mutual Fund. So Anirudh, we understand the basics now a little bit. Let's get to know about the different types of debt funds and how can we use them. So can you explain to us what's the difference between FMPs or target maturity funds, roll down funds, and constant maturity funds? And how are they different and how can we use these different types of funds?
My goodness, I don't blame investors for being, I'm confused
Okay.
with all these
So
terminologies.
I repeat, it's FMP.
No, it's cool. I'll answer that for you. Target maturity funds are the hot thing these days, TMF as they call it. I think 40 odd have been launched just in the last 12, 16 months. So how it works is basically they're just like debt funds, and they basically share some characteristics of FDs. But basically they invest in a basket of fixed income securities itself. But basically what happens here is they track an index. An index, for example, it could be a 2027 GSEC CRISIL index, for example. All right. So this is a basket of bonds that's going to mature in about 4 years. Right. So what a target maturity fund will do is it'll just passively invest in a basket of fixed income instruments to mimic this index and then hold it to maturity. So it's actually as simple as that. So there's nothing to be done here. I've bought that and I'm holding that portfolio of bonds to maturity. I'll tell you how it's useful and how it's also sometimes tricky. The underlying YTM of this portfolio will keep fluctuating, right? So when I have invested, it could be that at that point, the underlying YTM of a 2027 CRISIL index was maybe 7.5%, right? Now, for whatever reason, suddenly YTMs go up hypothetically, which basically means that now if I invest a year later, the YTM of that same fund could be 8%. Right? So that's what it means. So a rising YTM means the bond price is falling, which happens in a rising interest rate scenario. For example, we have the 10-year GSEC right now fluctuating between 7.3, 7.4. A year and a half back, it was much lower when interest rates were low. Someone who invested in the same TMF at that point when rates were low would probably earn, if they held it to maturity, they would earn a lower rate of return overall till maturity than if I went in and I invested today at that higher YTM. So since it's a passive strategy, there's no buying and selling except to basically finance redemptions. A TMF has a more predictable kind of a return if I hold it to maturity, mind you. If I don't, the NAV will fluctuate because these are not close-ended funds like FM. So when you talk about a roll-down strategy, this is exactly what it is. Roll-down strategy is followed by a TMF, which means basically that I start off, let's say when I launched the fund in 2020, it had a 7-year maturity, right? And as I went along, the maturity kept reducing, right? In 2022, the maturity would be 5 years, 2024 would be 3 years, and so on. So that maturity keeps rolling down. So that's what's called a roll-down strategy. I'm not keeping it constant. I'm allowing the maturity of my portfolio to roll down from 7, 6, 5, 4, and so on. And the last year, it's going to be just 1 year. And like I mentioned earlier, to tie in those 2 points together, it will have very low interest rate sensitivity, right? Because now the residual maturity is just a year. So that's how TMFs work. I can hop in and hop off anytime. But the idea is if I want to really truly benefit from a TMF, I should try and get in at a point in the interest rate cycle where YTMs are high. Let's say right now, so they're higher than average, where maybe the inflation cycle is peaking out, which basically means that there's limited room for the RBI to raise interest rates further, which is the scenario today, and then kind of just stay put rather than trying to time my entry and exit. Once I enter, I should ideally just try and hold it to maturity. Since it's open-ended, I may want to access that capital many a time, in which case I will be subject to NAV fluctuation. But if I hold it to maturity, there is a fairly high chance that I will get that initial YTM that I locked it in at, unless there is a credit event in the portfolio, which usually these funds wouldn't choose that. So that's your TMF, that's your roll down. The opposite of TMF in a way is constant maturity. where the fund manager's mandate is to keep the maturity constant. For example, I think a 10-year gilt. Okay, so you've got certain gilt funds which will always have a 10-year maturity. So they won't allow it to roll down. It's not that they will allow the bonds to mature and you will not keep rolling down the maturity. You will constantly endeavor and rebalance your portfolio to keep the average maturity at or around 10 years. These are obviously much more volatile, right? Because they don't have a roll down strategy, which means even if I buy and hold it for the 7-year period, I may be subject to interest rate fluctuations in that time frame. And if I'm unlucky, when I need my money, I may be at a point in the cycle when there is a capital loss in my portfolio. So that's how a constant maturity fund is different. FMPs are kind of somewhere in between because while they're not really target maturity funds, they're locked in, they're close-ended. I can't hop in and hop off. The fund manager will collect money during the NFO and invest it in a basket of securities, which are more or less aligned to the duration of that FMP, which could be random sounding numbers like 1,367 days and 1,284 days. People wonder why. Reason being that you're looking for an extra year of indexation. So if I launch an FMP on 25th March in a year and I let it mature on 3rd of April the year after, so I've essentially captured the indexation of 3 financial years rather than 2. So that's how FMPs work. They're locked in. Since they don't allow me an interim redemption, I'm not subject to interest rate volatility because I can't pull out in the middle. I will eventually get as much return as my underlying portfolio gives me, net of any credit events. And there is a reinvestment risk also in FMPs, which you can't see because ultimately it's very difficult to exactly align your portfolio to that maturity value. So there could be a point when some bonds mature and I'll have to now go back and reinvest that money for, let's say, a couple of months till that FMP matures. So did I cover everything?
Yes, very well explained, Anirudh. In fact, this would certainly help our investors to select the right kind of funds based on the kind of duration also that they are looking at. You mentioned about the interest rate cycle picking up. So from the point of view of interest rates, do you think long duration funds are back in flavor? Can you tell investors what are these funds and how can they use these funds?
See, long duration fund is any fund that has a portfolio duration of anything from 7 to 10 or 11 years because they are sensitive to interest rates. It works both ways, like I mentioned earlier. So if interest rates start coming down, you will have a scenario where there will be capital gains accruing in the portfolio, which are directly proportional to the portfolio duration. So if I invest in a long duration fund with a portfolio duration of 10 years, and if interest rates come down by 1%, I can expect a 10% capital gain over and above the coupon payment. So there have been situations where gilt funds have given 16, 17% as well. That's the reverse. Whether or not we're in that scenario right now, it's very hard to actually decide or time that. Interestingly, a lot of dynamic bond funds haven't done well. So reason being that it's extremely difficult to actually figure out when to get into what duration. I believe that's very, very tricky. So I may not be the right person to actually take a call on whether this is the peak of the interest rate cycle. But I do believe that inflation is coming under control. So logically speaking, there is probably a limited upside to rate hikes right now. If we're not already at the peak, we are nearing it. Whether or not it'll start coming down is anyone's guess. Again, that's a future event, can't be predicted. But there's no reason why you shouldn't. If you're a debt fund investor who's looking to do asset allocation, not a goal-based investor, there's no reason why you shouldn't start allocating about 10 to 20% of your portfolio systematically in a staggered manner to a long-term gilt or a 10-year constant maturity. It could give you a little bit of a boost to your overall portfolio.
Right. So you told us about the basics of debt funds, how and what kind of parameters one should look at, and what are the different types of fixed income. I'm curious to ask you about some observations from the union budget this year. We've heard India is setting up a $4 billion fund to provide liquidity to the corporate debt market. How is this going to help the debt market and impact investors' decisions towards selecting any particular class of debt funds?
So this is a reaction to what happened in 2020 where liquidity froze. So there was no buyer of last resort, right? There has to be a buyer of last resort when it comes to junk bonds, when liquidity and demand for this paper dries up completely and retail investors need their money back. You can't just lock the fund and deny them the money. That creates a very scenario where there's a loss of faith in the industry as a whole. So I think this step was taken to restore faith in investors' minds towards lower rated debt, right? Because there has always been a vibrant market for AAAs and GSEC, but when it comes to lower rated debt, there have been cycles where the liquidity has dried up. So I think this does give some amount of comfort to investors in the sense that there is a buyer of last resort. And in the future, if there's an event which creates so much redemption pressure, which subsequently leads to a liquidity crunch, then there is a buyer of last resort. So of course, it's positive for the industry. I don't think any knee-jerk portfolio moves need to be made in light of this. Let it play out. Like I said, there is really no reason to take an unnecessary credit risk for chasing that 2-3% for a 3-4 year period. We just don't see the logical sense in that. I would rather, like I said, earn 2% less a year for 3 years and sleep well at night. Because if it's debt funds, it is basically an FD alternative money that's going in. I would really like to not invest in any high credit risk funds despite this particular development. Although it is definitely good for the industry, I would like to see how this plays out in the scenario of any future credit event that may come up and how well it is tackled before I'd advise a retail investor with a limited understanding of credit risk to go in and even invest into such a high risk fund, just basis this particular development.
Absolutely, that makes a lot of sense. Also, we have heard about the taxation changes in market-linked debentures. So do you think debt funds can be suitable substitutes to these market-linked debentures post the change in taxation in the union budget this year?
Yeah, most certainly. I don't see why not. The short answer is yes, very much. So one can consider a TMF kind of a debt fund as a good alternative, something with a roll down strategy of 5-7 years, because the tax arbitrage that used to exist in MLDs was taken away. It's just not that attractive anymore. I would certainly suggest that the money that was there could go into target maturity fund or even a short term or a medium term kind of a debt fund at this point is probably a better alternative.
Understood. Anirudh, do you think that debt funds are more suitable investment opportunities when it comes to senior citizens? And given that life expectancy is increasing, can senior citizens, realistically avoid equity funds totally and concentrate on debt funds?
There's no such thumb rule, it says that senior citizens shouldn't invest into debt funds or that 100 minus age. The truth is that everyone's scenario is different. Even you're seeing so many different kinds of senior citizens these days. I know of senior citizens at opposite ends of the spectrum, those who are, even after retiring, able to fund literally all their expenses, medical costs included, purely from other consulting jobs or even rent. So this senior citizen would have to approach their portfolio extremely differently from, let's say, someone who has retired with no source of income. And basically, if they have to just generate returns from their portfolio for, like you said, excuse me, for a very long period of time, because life expectancy is going up. We're talking about a post-retirement income generation phase of anything from 25 to 35 years. And when you bring inflation into the picture, it is massive. So while that begs the question on, should I preserve all that corpus? The bigger question is, how do I keep drawing on that corpus and optimize it so that it lasts for 35 years? So there's this very difficult interplay at this point. If you end up taking too little risk, your returns will just not be good enough to account for the fact that you're going to live long, touch wood. And if you take too much of risk, and if you don't do it well, then you could end up making decisions, behaviorally speaking, that could reduce your corpus by half. And then you are basically in no man's land. Because I'll give you an example. If a retired person had put 50% of their money into a small cap fund before the pandemic, their portfolio would have seen an overall drawdown of 30 to 35%, which means a 5 crore retirement corpus would have become 3 to 3.5 crores. And with the panic that was setting in at that point, it's very easy to say now that, you should have hung in there and market should be invested in for the long term. Hindsight is 2020. When you're really in that situation, you see your retirement corpus dwindling from 5 CR to 3 CR. All you can think of is, how do I not let it go from 3 to 1? And then you end up taking decisions that could make your unrealized loss into a permanently realized loss, because once you hopped off that bus, there's no going back. Why I'm saying this is, in a nutshell, retired people cannot afford to ignore equities. You cannot have a pure debt portfolio anymore. Regardless of your risk tolerance, you will have to generate somewhere in the range of maybe 8 to 10% post-tax. And I don't think an 8 to 10% post-tax can consistently be achieved without taking at least some sort of exposure to equity. So one definitely has to consider an equity allocation. It is very critical to evaluate the risk and to have the support of someone. If not you, either you are able to support yourself, your own behavior. If you can't, then you must rely on someone who will handhold you into that through those times and say, hang on, this has happened before. And every single time it's rebounded. So don't turn this into a loss. Don't turn this into a realized loss. Hang in there and really maybe counsel you. Such a person could be invaluable. If you can do it yourself, you've got the sense and you've got the experience to invest in such a manner, well and good. You don't need the support of such a person. But what I'm trying to say is, it is critical for any senior citizen to invest in debt and to also educate themselves on how the risks of equity work. And basically, if I was a senior citizen, I would consider my portfolio as two parts. One is the low risk part, which I would draw down on occasionally, use to fund my expenses and my medical expenses, etc. And one is my equity part, which I won't look at all. Let's say out of 5 crores, I would put 2 crores or 1 crore away, and I would really just leave that because I don't really need it. I would look at that after 5 or 6 years. I would give that a very long-term horizon. So I would look at it as two separate portfolios. It's just a mental trick, but it does sometimes work. If I look at it as two separate portfolios, one being my growth portfolio, one being my income and emergency fund kind of portfolio. So all senior citizens have to do it. The only question is what proportion. You cannot avoid taking risks anymore, unfortunately.
Right. So what, in your opinion, are the most common mistakes that people make while selecting debt funds, and how do you advise them to avoid those mistakes?
The top one that comes to mind is to invest based on short-term past returns, or to invest based on a very myopic view. For example, just looking at YTM. Okay, now where is that YTM coming from? Well, like I mentioned, YTM could come because my bond price has fallen a lot in value. Why has it fallen? Sometimes the market knows more than you. The bond price could be falling because it's about to fall off a cliff. Right? So the market knows that there is a credit event going to happen in this portfolio. And so it's selling off, thereby raising the YTM. And I, as an investor, unfortunately, who is unadvised or who doesn't have the required resources and knowledge, I'll just see, oh, wow, YTM of 13%. Okay. Without realizing that comes with an immense amount of risk. So I think that's the first mistake, judging a fund based on a single parameter and not looking out for any red flags. The second mistake is to think of debt funds as an FD. A lot of people do that. They say debt funds and FDs are the same. Couldn't be farther from the truth. Debt funds and FDs have to be approached very differently in terms of the investing mindset, in terms of the understanding required, in terms of the objective. Okay. And I think the third thing would be to, again, like I mentioned, try and chase that incremental 1 or 2% return by taking very high amounts of risk in a debt fund for a short-term goal. It just doesn't make sense. Be happy with a 7%. Don't chase that 8.5%, 9% for a 3-year goal, because it comes with a very high amount of risk, I would say. Sometimes the way those risks play out is unimaginable. So I don't think it's worth it. I think these are the top 3-4 mistakes. And I'll also add another mistake. Staying invested in a debt fund for way too long is a mistake. I have seen investors coming in saying, let's keep it in a debt fund for a couple of years, फिर देख लेंगे. And then that dekh lenge never happens. And then 6 years later also, you're sitting in that same debt fund earning a pittance, 7.5%. 10 years later, also you're earning 7.5%, when the compounded return could have been 11-12%. And with every passing year thereafter, you're losing out on a massive wealth creation opportunity. So again, so goal alignment and goal linking helps. If I align my investment to a 10-year goal, I'll automatically come back to it and question, is this the right fund for me to be in? Is this fund the right fund for a 10-year horizon? So don't stay invested for too long in a debt fund, unless, of course, it's part of a structured asset allocation and you already have a very large corpus. Like I said, the two scenarios are two completely different scenarios. One where I've got my corpus in place and one where I'm looking to build my corpus. The two scenarios are 100% different.
Right. So Anirudh, thanks so much for joining us today and sharing your valuable insights on how do we select the right fixed income funds. Some of the important points that I could make a note of, though we discussed a lot, you highlighted return of capital is more important than return on capital.
Yes.
Risk profiling is going to be is important both from the equity and the debt funds perspective. We should not take too much of high risks when it comes to credit risk opportunities funds. When it comes to retired individuals, they should be considering both equity and fixed income and not just concentrate on only one kind of asset classes.
Yes.
You did highlight about a few mistakes that various individuals do when they try to select debt funds. For instance, they look for short-term returns, or they look at single matrices like YTM, etc. And they should not get confused between the fact that debt funds and fixed deposits are not the same. They're very different from each other. So these are some of the key takeaways that I could sum up, and I'm sure the rest, our investors, would have taken a note of it. To all the viewers here, if you need more help selecting the right fixed income funds for yourself, leave a comment behind in the YouTube stream and we will contact you ASAP. We also understood that whether you talk about equity funds or fixed income funds, the first step probably is to evaluate your risk appetite and risk score. So we highly recommend that you visit our website www.dspim.com and use the personalized recommendation tool called Sarthi. It's a complimentary tool for everyone, whether you're an investor or not. And it'll just take you 5 minutes to know yourself and your risk appetite better. I'm going to share the link in the bio for Instagram and YouTube description for your reference. I really hope that you take out some time to check it and use it. Anirudh, thanks once again for joining us today.
Thank you. Thanks, Sumana.
Happy investing to everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.